Hello, everyone. 8 p.m. Eastern on a Wednesday, which means it is Taxes and Retirement Live. I am Andy Panko, owner of Tenon Financial and moderator slash admin of the Facebook group Taxes and Retirement, which you all obviously are a part of since you're watching me now. Thank you for joining. Tonight is another fun mailbag edition, which is open Q&A. Feel free to ask me anything. Typically about financial planning, tax planning, retirement planning, but could be whatever. I am more or less an open book, I like to think. We do have one question that was sent in ahead of time, so I will get to that. But otherwise, there's nothing on the agenda so far tonight. No pre-sent questions. So feel free to plop questions in the comments. I'm just looking here. Okay, yes. Happy Thanksgiving to you too, whomever this is. So I see comments are working. Mark, happy Thanksgiving. Thank you for joining. And there's a question here. Okay, so yeah, so dump your questions in. And as always with these, normally, I encourage folks to feel free to chime in and reply to other people's comments or questions. But for tonight's sake, for these mailbag things, I just ask that you don't reply to other people's questions if you know the answer, simply because with my streaming software, I can't see who replies to what. I see every comment or reply. They just stack on top of one another, so I can't tell what's attached to what. So it makes it a little clunky for me to figure out if someone's already, addressed or answered the question. So anyway, let rip with your questions, but please refrain from answering other people's questions if that's okay. Thank you. Quick update for those of you who care. I feel like maybe a lot of time to fill tonight, so I'll kind of ramble a bit. Weight loss update. So I forgot last week to mention where I was at. As you know, I was away for a few weeks, 1 week on vacation, 1 week at a conference right after that. Both of those weeks involved complete disregard for weight loss. I did go running a few times in each place, but otherwise ate much more than I should, ate much worse than I should, drank more than I should have. So no surprise, I was expecting to gain some weight. All said and done, I was this Monday, I was 169.5, which is 2 pounds higher than what I was 4 weeks prior, which is kind of what I expected. I ate and drank like a sailor on leave for those 2 weeks. So I was expecting to gain some weight, which I did. And now parlay this into Thanksgiving, I'll probably take down 3/4 or maybe even a whole pumpkin pie on top of some sides. So we'll see. But otherwise, barring tomorrow and excessive eating, I'm more or less back on track with kind of eating well and working out well. So things are getting back to where they should be. And just to recap, I started at 176.1. I don't remember how many weeks ago it was. I was averaging about 1.25 pounds of loss per week, which was my goal. And as I mentioned, a few weeks ago, I got derailed from 2 weeks away. Now slowly getting back to it. So all is good. For those of you who care, for those of you that don't, sorry for that. Dad jokes for the evening. I do have one that's quasi Thanksgiving related. What do you call a herd of giggling cows? Laughing stock. The earth is 70% uncarbonated water. Therefore, the earth is flat. You get it? You know what I'm saying? So maybe the flat earthers were onto something. Maybe they were just referencing the fact that the water does not have fizzy bubbles in it. And finally, this is the one that's sort of Thanksgiving-ish. It's nothing great, but it at least mentions a Thanksgiving food commonly eaten at Thanksgiving. What's the difference between a sweet potato fresh out of the oven and a pig thrown off a balcony? Anyone? Bueller? One is a heated yam, and the other is a yeeted ham. I'll be honest, I didn't know what yeeted meant. Y-E-E-T-E-D. So to yeet means to like hurl or throw something with force and velocity. So yeeted ham means throwing a pig off a balcony with some force and velocity. So that's that. That's my dad jokes. And before we really get rolling, let me just hit you all with the disclaimer, if I can find it. Here we go. This video is only general explanations and education. It is most definitely not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I'm not. I'm just some guy here on the Wednesday before Thanksgiving, answering your questions, hopefully getting them right, maybe getting them wrong, but I'll try my best to get them right to the best of my knowledge and abilities. But again, I'm not your advisor. I'm just some dude on Facebook. If I am your advisor, then I wouldn't be answering your questions here. We'd be having our conversations offline and whatever. But for purposes of tonight, I am not your tax, legal, or investment advisor. Alrighty. Comments. I see we got some more questions here. Cool. Thank you all. Mark Troutman did ask the tax, when were the 2022 tax info getting updated? Sent that out when it was, and also forwarded along the 2022 summary tax sheet in the group the other day. There's another one, as I mentioned, that comes out from the College for Financial Planning, which is not yet available, but I will share that when that's out. That one I actually like a little better than the one I already shared. I don't make that one. I just I buy it from someplace. I slap my label on it and send it out. I have no control what's actually in that summary that I shared with you all the other day, but hopefully you enjoy it nonetheless. Okay, questions. First question was from Gail. Gail asks, can you talk a little bit about I-bonds and your thoughts? My thoughts about I-bonds, or my thoughts in general? No, I assume about I-bonds. Why are we hearing so much about them right now? Great question, Gail. So they've been discussed in a group a few times, and I did share, I don't know, a couple of weeks ago, a summary that I wrote and sent to my clients. I shared in the group as well, just kind of explaining my thoughts about I-bond. So I'll try to summarize that succinctly. So basically, an I-bond it's kind of more so like a savings account than a bond per se, but it is a security you buy direct from the Treasury, United States Treasury. You can only buy them through treasurydirect.gov, right from the Treasury website. Or you can buy some with your refund on your tax return, if you have a refund on your tax return. But outside of that, you can only buy them direct through treasurydirect.gov. You cannot buy them through a bank, through a brokerage, whatever. It has to be the Treasury website. You can buy per taxpayer up to $10,000 per year. So if you're married, that's $20,000. If you do have a tax return refund that you want to use to buy some I-bonds, you can take up to $5,000 of tax return refund and buy more I-bonds that way. So at most, a married couple can get $10,000 per person, so that's 20, plus maybe another 5 for your tax return, so that's 25. Now here's a little more complicated. If you have a trust, specifically if that trust has a different tax return, a different taxpayer ID than you, like an irrevocable trust, that trust can also buy up to $10,000 of I-bonds per calendar year. So you buy it, and then, so what's the magic? Why is everyone talking about it? Well, the interest rate they pay changes every 6 months. And that rate is reset based on actual realized inflation over the prior 6 months. So every 6 months, it takes a snapshot of what the change in inflation was, and that's the interest that it pays for the 6 months. Well, since inflation has spiked in the last year, specifically in the last 6 months, it really went up. The interest rate is currently really high on I-bonds. Specifically, for any I-bond you buy between now and May 1st, 2022, for the first 6 months you hold that bond, you will get an annualized guaranteed interest rate of 7.12%. Guaranteed. No risk of loss. You put $10,000 in, you will get an annual rate of 7.12 over 6 months. So, over 6 months, it's actually 3.56% of interest that you earn over 6 months. Again, annual rate just simply means take this, I'm taking what you would get in a year, divide it by half. That's the amount you actually earn on your first 6 months. The second 6 months you have this bond, we don't yet know what the interest rate will be. We have to wait until May 1st, 2022, when we realize what inflation there is between now through then. The Treasury will then set what the 6-month interest rate is at that point. And that interest rate is what's going to apply on the subsequent 6 months of your bond. So anyway, so every 6 months, your interest rate keeps resetting to whatever inflation is at the time. If inflation stays high or keeps going up, these things are going to keep paying pretty high interest, guaranteed interest. There's no variability, no risk of loss. If and when inflation goes down, the interest rate is going to come back down. So that's kind of I-bonds in a nutshell. Now, there's some caveats to know. When you make a purchase, you cannot redeem it at all within the first 12 months. It's completely locked up. There's zero option to get out of it in the first 12 months. After the first year, but before the 5 years is up from when you bought it, you can redeem it, but there's a relatively small penalty. The penalty is the most recent 3 months worth of interest that you accrued. You have to give that up if you sell out of this bond within the first 5 years, between 1 year and 5 years. After 5 years, completely unrestricted ability to redeem. There's no penalty. There's no whatever. These bonds throw off interest for, I think it's 30 years. drawing a blank. It's either 20 or 30 years. So you can hold these bonds for 20 or 30 years. They'll keep paying you whatever this inflation-based interest is every 6 months. After the 20 or 30-year period, they stop accruing interest. At that point, it's just done. There's kind of no point in keeping it. Now, honestly, I don't know if the Treasury force redeems them on you and just like, gives you back your money, or if they just sit there doing nothing until you consciously request it. I'm not entirely sure, honestly. So that's the big buzz about I bonds. Compared to high yield savings accounts or checking accounts pay interest of literally 0.01% typically. High yield savings accounts pay about 0.5%, maybe a little more. If you're lucky and you're a member of a credit union or something that has a high rate, maybe you're getting over 1%. But for the most part, cash at traditional bank accounts is earning nothing. Now, let me just share with you the history of I bond rates. Here we go. So again, every 6 months they reset. It's every May 1st and November 1st they reset based on the actual realized inflation, for each 6-month rolling period. So on November 1st, 2021, the 6-month rate is 3.56. So here, and this is right off the Treasury Direct website, these columns A and B. Here, I just simply took the 6-month rate and doubled it, just so you all can look at this on an annual rate, because most interest rates are quoted on like an annualized basis. So 7.12% is the guaranteed rate of interest you'll earn over, annual interest you'll earn over 6 months. That's high. That's really high. But again, it changes every 6 months. Who knows what it's going to be after that? You can't redeem at all in the first year. You can only put in $10,000 per taxpayer plus a little more in a tax return. So it's not like you can take, $200,000 of cash that you have sitting in a checking account and swing it all into I bonds. You just can't. So while the interest rate is really high on these, there's kind of like limited value and limited use cases for where they make a lot of sense. If you don't already have a lot of I bonds, is it worth it now to start piling in to the tune of 10,000 per year? I don't know. It's not going to hurt, I don't think, but you got to be careful again of the lack of redemptions in the first year. But you're not going to amass a fortune starting to buy I bonds now, because it's going to take you forever to keep buying in, 10 grand per year per person to get a really big amount of I bonds. But anyway, just so you can see quickly, and I'll wrap it up here. So as of November 1st, the annualized rate was 7.12 guaranteed. 6 months prior is 3.54, 1.68, 106, 202, 140. So you can see. So interest rates have been, for the last handful of years, fairly high, higher than savings accounts. Savings account interest rates have been well under 1% for a while, whereas I bonds have been, 2-ish, maybe a little more. It was flat 2016. It was actually negative in 2015. Now, fun fact, I bonds will never pay you negative interest, even if the actual inflation is negative, meaning deflation. The rate you'll earn will never be less than 0. So you cannot lose money in these I bonds. So anyway, so the interest rates have been higher than cash. I never thought they were that compelling enough to tell people, stop putting money in savings, put it in I bonds, just simply, again, because of the restrictions around how much you can buy and the redemption periods. I was like, for that 1 or 2%, it's not really worth it. But now, Shazam, when guaranteed interest is 7%, it's like, I start to notice now, and I feel obligated to tell clients this may be something worth looking into. Again, it's not going to change your life because you can't put a lot of money into it. But at this level of interest, I'd be remiss if I did not, point this out to people. Like, hey, this is a lot of interest. All right, so that's I bonds. Gail, hopefully that answered the question. Let me stop the screen share. And I got new lights over me. It's a little more washed out and white and putrid than I was hoping. There's 2 big fluorescent overhead fixtures, and I didn't realize till the one over me had 2 bulbs out that was kind of dim. So I went to Home Depot, got some new ones, and I put them in. It's like, wow, these are really bluish and washed out, whereas the other light I have is a little more warm and orangish. So I may go try to find different bulbs, because I'm already pretty pasty and washed out as it is. I don't need this making me look transparent. All right, let's questions. What do we got here? Craig Root. In preparation for moving, we are selling everything in the basement and barn through online platforms. They have contacted us saying a tax form will be generated. This is old stuff that we are selling for much less than we paid years ago. We have no receipts. I'm sure we will break the $600 barrier next year. How do we prove we didn't buy this at a yard sale and sell it for a profit, as many people are doing? Oof, that's a good question. So technically, anything you sell is supposed to be reported to the extent you have a gain on it. Like even I don't know. Yeah, I'm drawing a blank. You buy a refrigerator 5 years ago and you sell it today. If you have a gain on it, you're supposed to pay tax on it. Now, realistically speaking, nobody does. So let's assume you bought a used refrigerator a few years ago for $100. Someone was unloading it for dirt cheap. You turn around, you sell it today on Craigslist for $300. You made $200. You're supposed to report that to the IRS. In practice, nobody does. I'm not saying it's right. I'm just saying nobody does. Because there's no real paper trail, especially if you did it as a cash sale through text or whatever. It's not like the person you sold it to issued you a 1099. But now, and I'm not that familiar with this, but I did read some quick headlines that like Etsy and eBay are going to start, if they didn't already, start issuing 1099s to report people's sales through those platforms. I guess this is what you're getting at, Craig. So now how do you prove that the proceeds for what you sold as reported to the IRS on the 1099s, it sounds like these places will be sending, how do you prove that wasn't more than what you paid for it and that you don't have reportable taxable gains? Man, I don't know. I'm going to say the honor system. I mean, realistically speaking, if you sold, an old desk for $50, and you sold a whole bunch of stuff that was like $1,000 in total, and you get this 1099 saying you had $1,000 in proceeds. I honestly don't know what the form's going to look like, if any, on the tax return. It may just be honor system for you to detail yourself what you sold and what the basis, what the cost was. So I don't know. Realistically, I doubt the IRS is going to give people trouble over this. If it's only, $1,000, a few $100 or whatever, if you have tens of thousands of dollars of reported sales, then it's probably an issue. Then you would want receipts or some sort of substantiated, documented proof, however you can cobble it together, of what your original cost was. But my guess is for a few $100s, $1,000, especially if it's sporadic, every year or so you're selling some stuff, I doubt they're going to raise a flag. Unless you're at higher audit risk for something else. I don't think this in and of itself, again, unless it's a lot of transaction, a lot of dollars, I don't think this in and of itself will be likely to trigger audits for folks. But if you're already high audit risk, self-employed, lots of other deductions, or what are other audit risk things, or you fail to report some things that the IRS gets 1099 for, cross all your T's, dot all your I's to try to limit your audit risk. But otherwise, you should be okay. If they do come asking, just be honest. Be like, I don't know, this is a bunch of random stuff we had from decades ago. I don't know what we got it for, but guaranteed now it's worth less than it was then. That's the best I can come up with. Good question, Craig. Sorry, I didn't have a better answer. Mariel Sitman, rule of thumb on when to stop collision and or comprehensive coverages on auto insurance. I don't know. This may I was going to say, does it depend on state? I don't know. I'm not an insurance expert. I mean, I know enough about property and casualty insurance to know what it is, how it works. Maybe some states require you to have a minimum amount of collision and or comprehensive. I don't know. I think most, if not all, states require liability at least. But outside of that, the best I can say is the overarching approach with insurance is you really only want to buy insurance. I forget what the exact title labeling is, but you really want to only buy insurance for things that the probability of them happening are relatively small. And if and when they do happen, the financial impact is large, and large enough that you can't safely absorb it yourself. That's why I buy homeowners insurance. Chances of your house blowing up or getting knocked over or burning down are really slim. But if and when it does happen, it's hundreds of thousands of dollars, and most people can't absorb that. That's something you insure. Life insurance. You're young, you're in your peak earning years, you got young kids, you got people that depend on you financially. You die, that would be bad for your family. Chances of you dying, relatively small. Financial impact, quite large. That's something you want to insure. Car insurance, kind of the same thing. For a lot of people, if a car gets scrapped and they got to pay 40 grand out of pocket for a car, that they can't really do that. So do the math and figure out, if you have older, not so expensive cars, and if it does get scrapped in an accident, not a big deal. You got 20 grand lying around to go out and buy a comparable, replacement used car. Maybe you don't need the coverage. Now, I'm not going to tell anyone drop insurance, because as soon as I say that, guaranteed to get into an accident the next day. But that's just sort of things to consider with insurance in general. Again, if it's low probability of happening and large financial impact, it's something you probably want to insure. With a car, you determine, could you comfortably fund the replacement of a car if something happened with collision? Now, again, you have to check like damage to others and people sue you for liability and pain and suffering. Like that's something you want insurance for because that can be a lot of money. But simply replacement cost of a car or even replacement cost of damage to someone else's car, that's kind of for you to figure out the math if you're comfortable insuring that yourself or funding it yourself as opposed to paying for insurance for it. So no rule of thumb, but just food for thought. Me personally, I'd sort of rather just keep insurance. It's relatively low cost. I mean, I'm in New Jersey, so it's expensive, I guess, but low cost enough. And I think I have $1,000 deductible, maybe more, just because like I'm comfortable paying for that out of pocket. If and when there's something big, tens of thousands of dollars, yes, I'd lean on insurance at that point. But otherwise, I see me always keeping it just because I don't know. I'm also fairly conservative in many aspects. So, but that's me. Everyone's answer is going to be a little different. Good question. I feel like not a great answer, but hopefully it at least piqued some things to think about. When making financial decisions, would you discuss good enough versus optimization and how to decide which is better? This kind of sums up tax planning really well. Good enough is what people want to shoot for. If it's not good enough, you have problems. Good enough will suffice. Optimization, it all depends. Are you interested in doing it yourself? Do you have the time, the knowledge, the willingness to figure this stuff out yourself? If not, are you willing to pay someone for it? And if so, how much are you willing to pay? Good advisors that know stuff about taxes and whatnot shouldn't be cheap or aren't cheap and probably shouldn't be cheap. Is it worth it to you? It all depends. My thought about optimization, whether it's tax location, whether it's tax efficient distributions and things like that, you've probably heard me say this before. Tax planning and getting tax planning right, in most cases, will make a good plan better, but it's not going to derail a plan that's already good enough. As long as your expenses are under control relative to your other income sources and asset size. If your expenses are under control, if your overall allocation is right, if you're conscious of keeping your fees down where you can in your investments and such, that's the big stuff. That's the stuff you have to get right, and to get that at least good enough. Tax planning, getting tax planning wrong, not getting your asset location right, meaning you don't which asset types you have in which accounts. Getting that wrong isn't going to sink an already good base solid plan. Getting it right can make it better and optimize it. So I don't know. Some people sweat every detail. Some people want to answer these things to the penny and will run simulations and analysis all day long, every day for the rest of their life, just because that's who they are, always seeking this never-ending kind of elusive, perfect model, optimized model. It doesn't exist. You can always make things a little better, but there's never going to be, yes, this is it. This is the perfect, no ifs, ands, or buts. This is the optimized. I don't think that exists. So this is up to you. Some people are like, I don't care. Just get me good enough. I want to be happy. I want to not run out of money. As long as you say I'm okay there, fine, whatever. The rest of it is just gravy if it goes well. If it goes a little wrong and I'm still okay, I don't care. So it depends on the person. Good question. Interesting question. Do you have any opinion on real estate syndication, including funds, or the need, especially in retirement, to diversify outside of stock or bonds? I don't know. I mean, like any other asset class that's not a traditional stock or bond, a traditional financial investment, sure, there's a case to be made for diversity. Uncorrelated, the cash flows and or the changes in price are reasonably uncorrelated to traditional asset classes like stocks or bonds. In that sense, yes, completely get it. But the things you have to weigh, the trade-offs are less liquidity. When you own real estate, whether it's physical real estate, like you bought a rental, you can't get out of that quickly. It's going to take you a minimum few weeks to sell it. There's going to be friction costs between realty transfer taxes, legal fees, recording fees, stuff like that. So it's not a quick sale and it's not a cheap sale either. So there's that to consider. That's if you buy yourself. With the syndication, you have even less control. You basically, I guess there's different ways to syndicate. You can go through like a crowdsourcing. You can do a private syndication. But the point is you pool up money with others, and this pot of money goes out and buy real estate. You then own a slice of it. So I get it. There could be value to be had. I don't I won't tell clients who want or have real estate get rid of it, but I don't personally, my investment approach, I don't go out and seek every possible combination of alternatives and non-traditional asset classes to tweak things. My approach, for what it's worth, is traditional investments, low cost, simple, passive base, control what you can. You can control fees, diversification, to some extent taxability. That's it. That's what you can control. So focus on that. I have some clients that have quasi-private investments or interval funds, things they no longer want but can't get out of without selling little portions every quarter. Real estate's kind of the same thing, right? If and when you want out, well, guess what? You might be stuck depending on the syndication setup or depending on the REIT you're in, maybe a private real estate investment trust you simply can't get out of when liquidity dries up. So you have to weigh those things in. But whether it's real estate or anything else, dare I say crypto, I'm not recommending crypto. I'm just saying it is more or less uncorrelated to traditional assets. Yes, there's a case to be made for any uncorrelated or low correlated asset to potentially enhance not just returns, but safety and stability of a portfolio. So that's my opinion. Like anything, it could work. Maybe it will, maybe it won't, but it's all possible. It's not something I personally focus on, but yes, I can see where real estate can come into play for folks. Okay, what else do we have? Does reading the tax code ever make you want to yeet your computer across the room? Yes. Sometimes reading like legislation, reading these bills, like the Build Back Better Act, trying to comb through that's hard to read. So the tax code is hard enough to read. These bills and these legislative changes are even harder because a lot of what they do is they reference specific codes, specific sections in the tax code. So it'll say like section 807-C-3-4, add to the end of the last sentence, or the greater of. Or so I'm making this up, but the point is, like, you need to reference the tax code itself with a lot of these bills to see what they're actually doing. These bills don't just say we are increasing the tax rate from 5% to 20%, blah, blah, blah. No, you have to dig in the tax code, look at what they're referencing and do that. So yes, sometimes that makes me want to yeet my computer across the room just because they make it so hard to read. Well, they don't intentionally do it. That's just the nature of how the code is. But anyway, yeah, interesting question. Do I know of a good resource that compares current tax rates with what they will revert to in several years, inflation adjusted, relevant to making Roth first traditional decision? So no. Well, I have a few thoughts. So we know what the tax rates will be in 2026. That's easy. It's what they were pre-2018. We're going back to those same rates. What's changing is the dollar amounts of the brackets where those rates start and stop. Then simply just adjusted by inflation. So every year those things go up a little bit. Every year that there's inflation, I should say. So no one really knows what exactly those will be in the future in several years. It's anyone's guess what inflation is going to be. So I'm sure there's sources out there that make projections and predictions, but they're not necessarily any better or worse than you coming up with your own assumptions of what you think inflation may be, and therefore what you think the income brackets themselves may rise to over the years. So I don't know. I did, for what it's worth, I kicked around a trial of the software owned by Bloomberg called BNA. It used to be called BNA. It's called something else now. But it's this really robust, really like not user-friendly tax software that lets you do different what ifs, but it doesn't let you change assumed tax rates and stuff like that. It's kind of stuck. It has its own inflation assumptions built in, but that's it. You can't add like new taxes to it and things. So I didn't find it very useful. And I'm trying to find this, holy grail of how exactly, or what is the best process and software to try to quantify Roth versus traditional. And something doesn't exist. Frankly, I'm convinced nothing exists to do this right, because there are so many variables, and we don't know what those variables will be. We don't know how high tax rates will change. We don't know how high or low stock and bond markets will go. We don't know what inflation is going to be. We don't know what your own longevity in life's going to be. Maybe you die in 2 years and all these conversions were for naught. You don't get to live long enough to benefit from the growth in the Roth, perhaps. So no, I don't know of a good software that really helps answer, which is frustrating, because probably the most common question in this group is, should I do Roth conversions, or how much, or when? and there's no good way to quantify that. The best I can sort of say is like, I know a problem when I see it. If you got $3 million in an IRA and you're 10 years out from RMDs and you're in really low tax bracket now because you just retired, like, you got a problem. Don't let that 3 million sit there and continue to grow. Take some out now, whether it's through distributions or conversions or whatever, just because we know it's going to be an issue. How big of an issue, we don't know. That's pretty obvious to see. Outside of that, it's really hard to try to precisely pin down what is the right amount of Roth money to have. What is the right amount of conversions? Should I do conversions? Should I do Roth contributions or traditional contributions? The best I can say, which is kind of a cop-out answer, but it's really the best you can do in the absence of these big ginormous variables that we don't know what they're going to be, is just to try to ultimately get to retirement with your assets spread around in a nice healthy mix between tax deferred, Roth, and like regular stuff like brokerage or cash. What exactly is a healthy mix? I don't know. Third, a third, a third, 20%, 20%, 40%, whatever. Just ideally not like 95% of your assets in tax deferred, because then you don't have a lot of control or flexibility around the taxation of that stuff. So the more you can diversify your sources of account taxation, the better, but there is no right answer as to what's the best amount or right amount. All right, kind of got off on a tangent there, but man, these are tough questions from you all. These are all things that don't have clean, concise answers. I don't know if that's coincidence or if I'm just tired. Anyway, I apologize for these long, not specific answers, but this is kind of the best I can come up with for these for the questions you all are throwing. Here's another one. When considering Roth conversions, what return expectations on the converted money are generally used? I'm almost afraid to touch this. So it really depends. It depends how you're going to invest it. Generally, the conventional logic is leave your Roth to be invested with your most aggressive stuff and don't plan on touching the money for a long time. Let that aggressive stuff hopefully build up a lot of gain over time, and all that gain will be tax-free because it's in the Roth world. So with that said, assuming your Roth assets are going to be, your stock funds or most or all of your stock funds, the question is, what rate of return do you want to assume going forward for stock funds? This is where things can get hotly debated, and some people may start throwing punches depending who you ask and how passionate they are about it. Some folks will say stock market, since it's been running up so much in the last 10 years, it simply can't sustain this level of growth going forward and has to at least kind of stall out, maybe not crash, but has to stall out for a while. So those people are going to say, I don't know, maybe expect 4 or 5% annual return going forward out of stocks. There's other folks who are eternal optimists and perennial bulls will say, nope, party's going to keep going. Maybe not as high as it's been, but yeah, we still expect 7-8% stock market returns going forward. And then you have the doom and gloom pessimists who they're just, always saying the end is near. They're going to tell you, no, stock market's going to crap out and, it's going to be negative returns for the next 10 years. Absolutely nobody knows. So take all that noise and throw it out the window. You pick a figure you think you're comfortable with. If you are invested in stocks, an assumed average annual long-term return of anywhere from 4 to 8 or 9% is defensible. Not to say it can't be higher, not to say it can't be lower, but just throwing out a very, very broad range, mid-single digits to maybe high single digits for a well-diversified, globally diversified equity portfolio is probably a fair assumption. But it's just an assumption. You know what happens when we assume things. So anyway. Thanks, Mark. I bonds are 30-year maturity, not 20. Good. Yeah, so this person, I don't know who this is, but some older I bonds have a base interest rate. I forgot to mention this. So the interest I bonds pay technically have two interest rate components. One is a fixed rate, and then one is the inflation-based rate that changes every 6 months. The fixed rate has been 0% for the last few years. It used to be 3+% 20 years ago. And then it kind of trickled down over time, bumbled around 0 to 1-ish%. But the last few years, the fixed rate has been 0. If you did buy an I bond in like 2000 or roughly, you had a fixed base rate of 3%, meaning that I bond was always paying at least 3%. Then on top of that, it was paying whatever the inflation is. So if you owned an I bond from 20 years ago, you get this base rate of like 3%, and you're getting this 7% inflation on top of it. That's a lot of interest on an I bond. But that, hindsight's 2020. If you knew 20 years ago to stock up on these things in advance of interest rates, plummeting 20 years in the future, i.e. now, and inflation spiking, then yeah, you'd be a genius. But outside of that, you can't go back in time and go buy one of these 3% base rate I bonds. They simply don't exist anymore. Base rate has been 0 for a few years. How would continued high inflation with regards to cost of living adjustment payments impact the Social Security Trust Fund? That's a complicated one. So there's a bunch of moving parts. All else equal, higher cost of living adjustments means Social Security is paying more benefits out of the system, which means the trust fund will deplete sooner. On the flip side, and this is where it gets complicated, as inflation goes up, the wage, national average wages go up, and the wage amount on which people pay Social Security tax also goes up. So there's more money getting paid into the system. That helps offset it. But that's not free lunch. The more people pay in, the more you pay in over your life, the more anyone pays in over their life, the more benefit they ultimately accrue. So I don't know the answer is what I'm saying. I don't know which directionality in which inflow and outflow is larger or smaller than the other, and which one more or less offsets the other. So it's tough to say. The best I can respond is say, wait till next June, I think it is, when they come out with the next annual Social Security Trust Fund projection. Then we'll see in hindsight what this, what they think these cost of living adjustments have done to the trust or will do to the trust fund. But prior to that, I really don't know if it's going to help or hurt it. I would assume on net it would probably hurt it a little bit, but I really don't know. It's not that simple the way the formulation of Social Security works. What do I think about inflation protected mutual fund to park some cash in for the next several months? I don't know what you mean by inflation protected mutual fund. Do you mean like a mutual fund that invests in treasury inflation protected securities? Or is there some other product I'm not aware of that somehow has an inflation-based return in it in a mutual fund? But whatever, that aside, in theory, if it's something that's indexed to inflation, then sure, that by itself sounds good on paper, but it depends what you give up without looking at the security in the mutual fund and knowing exactly what's in it and how it functions. It may or may not help. So like treasury, why am I drawing a blank? Treasury inflation protected securities are bonds, treasury bonds, where the interest rate is fixed, but the principal amount on which that interest is paid adjusts with inflation. So that's how they kind of pay you more interest. If you own these bonds, as inflation goes up, the principal value that you own goes higher. And so therefore you're getting a more dollar amount of interest. But those don't pay a lot of interest to start with. The interest rate is really close to 0 on those. So in real terms, you're not really getting a lot of money for it. Plus, because they're bonds, this gets a bit technical, but they trade in the secondary market. There's going to be supply and demand forces that can swing things. So you can lose money on these bonds still. You may buy it at one price. If the market decides they lose favor in inflation bonds, the price of those bonds may go down. You may actually lose money on these. So they're not riskless, they're not foolproof. Unlike I bonds, where you cannot lose money in an I bond because your principal value will never go less than what it was, and you can never get negative interest in an I bond. So I bonds and treasury inflation protected securities are different animals. They're both treasury issued things, but the mechanics of how they trade and how they credit interest are very different. So anyway, it depends. I'd have to know more about the particular security to say whether or not, I think it could make sense. Oh, thank you, Jeff. I'm no more washed out than usual. Yeah, I'm usually pretty washed out. So it's good to know I don't look more washed out. Thank you. What is this? Any knowledge of IRS enforcement of crypto transactions and gains? I am self-reporting gains, spreadsheeting it. I spreadsheet a lot of my life. Ain't no shame in that game. Any idea if sites like Coinbase is generating any info to the IRS that would need to match? Just don't want higher chance of audit due to crypto transactions. No, I don't know. I do know this is a level, an area of increased scrutiny from the IRS, and rightfully so. It should be. There's no reason why crypto assets should be any less reported than stocks and bonds, other than the market simply isn't as developed. The players in the market aren't as developed. The custodians, if you will, these virtual banks aren't as developed. So they don't have the pipes and plumbing and reporting infrastructure yet. But in theory, yes, crypto should be transacted and reported to the IRS just the same as stocks and bonds at major brokerages. So I don't know if Coinbase and crypto banks of its ilk are starting to produce things that they send to the IRS. I've never personally bought crypto, so I don't know. They should. If they don't, they should really soon for everyone's interest, other than those trying to hide money. But whatever. With that said, I think spreadsheeting it for now is fine. As long as you keep decent records and you're honest about reporting gains and losses, nothing wrong with that. And if and when these Coinbases and places like it do start to develop formal tax reporting, then you'll need to rely less on spreadsheets, because that's going to be the proof. Unless they're flat out wrong in their reporting, in which case, yeah, maybe you want your spreadsheet to try to prove them wrong, but otherwise the source will be whatever form they send you, especially if a copy of that gets sent to the IRS as well. Yeah, and I don't know whether or not crypto transactions will lead to higher audit risk. Maybe. I guess because it is more of an IRS focus, I don't know what the, how high or how much more of a risk it is. If it goes from negligible to slightly less negligible, or if it goes from you go from 1% risk to 10% risk, I really have no idea. My guess is it'd also be a function of the size of the transactions, probably. Like anything else, size matters. With the IRS, the larger your income is, the larger your reported transactions, I think the more likely they are to question things, all else equal. But with that in mind, I would think crypto would lead to higher audit risk, but I frankly have no idea how much more. Murphy's Law. Here we go. I ended collision and comprehensive on my old truck worth about $5,000, and then it was stolen. Yeah, go figure. Like I said, I don't want to tell people to drop insurance, because as you're driving to Thanksgiving tomorrow, guaranteed your car gets smacked up. Anyway, I stopped homeowners insurance 30 years ago. Present value of savings is probably $60K. Yeah, it could work. Like any insurance, I don't want to call insurance a gamble, because it's not. It's insurance. You should lose money on insurance. You shouldn't get something insured with the hopes of having to need it. If when you do need it, you'll be glad you have it. But like life insurance, for example, you shouldn't be angry if you buy a 20-year term policy and you live. So after 20 years, you're like, darn, I just spent whatever, $1,000 a year for 20 years for nothing. I spent 20 grand for what? I got zero return. You should get zero return. You want to live. Well, most people, you probably want to live. That's how to view insurance. Don't view it as I mean, some people do. And I don't, I'm not knocking you, Perry. I don't know why I got off on this tangent, but homeowners insurance, car insurance, life insurance, even to some extent annuities, because now annuities are grossly missold, so not a great example. But I'm saying annuity in the sense of like buying yourself a stream of income is in effect longevity insurance, insuring against if you do outlive standard life expectancy. You're helping ensure you're not going to run out of money, because you have this annuity that's gonna pay off. That's going to pay monthly as long as you live. That's a form of insurance. It's longevity insurance. And like any insurance, you don't buy it to try to make money. You buy it if and when the unwanted event happens, you're at least somewhat protected. That's what insurance is. And homeowners is no different. You don't buy homeowners insurance hoping your house burns down so you get to make a claim and get paid out. No, you buy it and you spend that however much it is, $1,000, $2,000, depending where in the country you live and how big your house is, I guess. You have that expense every year, hoping and not expecting to have to use it. But if when you do, you're glad you have it, because it's going to cover $400,000, $600,000, however much your house and policy is. But yeah, if you want to take the gamble of not insuring and saying, yeah, I'll save myself the $1,000 a year, whatever it is, and just deal with if when I have an event, that's completely fine. That's your prerogative. And maybe chances are you probably will win that bet, right? Just because how many people actually have a complete home disaster, home casualty? Not many, or not most, at least. The majority of people don't ever in their life. So from a pure odds perspective, and I'm not advocating this, but from a pure odds perspective, most people probably don't need home insurance because they're not going to have a massive home event. But if and when you do, and that event costs you $500,000, if that's going to bankrupt or otherwise really break your financial life, you don't want that. That's something that you should insure, because you can't withstand the loss. So that's my thoughts on insurance. Karen, assuming you have about the same amount in retirement and brokerage account, what do you think about just rebalancing the retirement account to avoid paying capital gains in the brokerage account? That's what I do in practice, Karen. So for people I manage money for, a lot of them have brokerage accounts that they may have had for a while. If they had it for a while, basically everything is up. So everything's at a taxable gain. So what we do is generally just keep the stuff they have in the brokerage account. Don't rebalance it. Whatever it is, we just fold it into their broader allocation and then back into the rebalancing we need by way of rebalancing their IRAs or Roth IRAs or 401ks or whatever, because there's no tax implications of rebalancing those. Now, it doesn't mean we sit on the brokerage stuff forever. This is where it's a little more work involved and a little more function of what's going on in the world and the markets. We look for opportunities to sell things, either because client needs income and part of the tax plan for that year is, okay, we're going to get you $100,000 out of your brokerage account. It's going to be at, whatever, long-term capital gain, you're going to have to pay $15,000 in taxes, versus if we pull $100,000 out of your IRA, it's going to be taxed at 20%. So we kind of do this analysis every year to see what makes sense. It also depends what the markets are doing, if things are up or down, and what's the tax implications of that. But yes, generally speaking, I do this in practice. Don't touch the brokerage account. Only rebalance the other stuff, because there's no tax implications to doing it. So nothing wrong with not. I won't say nothing wrong, but completely valid approach. David Fultz, how frequently should someone check their investments? Do you think that the more we check, the more our behavioral biases come into play? No doubt, yes. Quarterly-ish. When you look at it daily, that does more likely than not prompt you to feel the need to want to or to have to take action. Action is usually not good. Action means emotions. Action means knee-jerk reactions. Get your allocation right in the first place. Now, what exactly is right? That's a bit subjective, whether it's 60-40 or 65-35 or 80-20. Depends on your stage of life and your emotional views towards risk and your financial assets and what you need them to do for you, blah, blah, blah. Get your allocation right. And again, control what you can control. Fees, diversification, allocation, to some extent, taxability. Outside of that, no, don't be looking at it daily, frequently. I look at stuff because I'm in the business and I have to do it, because I have a fiduciary obligation to clients to make sure the world's not ending or whatever. And if it is, to, maybe have to do things in their accounts, but otherwise I sit on it as well. Once a quarter, I go in, I rebalance everyone's accounts methodically, emotionlessly. Is that a word? Without emotion. I take all the subjectivity and guesswork. I do not market time. I simply, if a client's allocation was 60-40, stocks drifted up, now they're at 62-38, I'll go in and I'll rebalance. I'll sell some stocks, buy some bonds or whatever, get them back to 60-40. I do that quarterly, like clockwork. The middle of every March, June, add 3 to June is what? September and December. That's when I rebalance. If and when there is a major market move intra-quarter, a huge run up or a huge drop such that, that may really skew the allocations, then yes, then I'll go in intra-quarter and rebalance. But otherwise, if their allocations float around a few percent from the target, that's fine. Getting too fancy and you want to rack up lots of transactions and bid-ask spread and stuff like that by rebalancing daily or even weekly. So just pick a cadence and stick to it. Whether it's quarterly, semi-annual, I'd say at least once a year, people should be rebalancing and looking at statements just to know what's going on. But you shouldn't be touching it and playing around trying to rejigger it too frequently, because that's probably, more likely than not, good isn't going to come out of that. Thank you, David Fultz. I moved $20,000 from a 403B to a traditional IRA. I then plan to convert that over to Roth and pay income tax. Okay. Is there any rule on the funds has to stay in a traditional IRA for any period of time before I'm allowed to convert to Roth? Easy answer, no. Next. No, just kidding. Not to be rude, but no, there's not. Once the money's in your IRA, you can convert it in theory that same day, as soon as it lands there. Now, in reality, the custodian of the IRA will probably make the money sit there for a few days to fully settle. In banking terms, only once that cash is actually settled can you then convert it out of the account, probably. But no, outside of that, there's no restriction or no IRS rule that says the money needs to sit there and season for a certain amount of time before you can convert it. Good question. How to help a friend who says, I don't trust stocks. I'm keeping my money in cash. Just leave it alone. I feel like it's dangerous, even suggesting that all cash may have inflation risk and is not the best move long term. Do you think I can help if I Heavily caveat that stocks can lose significant value due to volatility and highlight risk, or still losing bet. I don't know. Depends on your friend and how stubborn and closed-minded he or she is. And I don't mean those as like derogatory or mean terms. Just that's kind of the best way I can think about it. If their mind is already made up, I don't trust stocks, I don't care what you tell me, then no. It's like trying to convince someone on one of the extreme ends of the political spectrum to change their mind and see the logic in some of their dumb views. It's pointless. You're going to get yourself angry over it. So don't bother. Now, sure, if you love the person, if you're genuinely concerned, I guess you can try. I don't know the dynamic between you two, so I'm not a therapist, nor do I play one on Facebook. And this could be terrible advice for all I know. But if you genuinely care about the person and you think he or she may be even mildly receptive to listening, or at least won't cut you out of their life for trying, then sure, then I guess you can try to make a casual kind of conversation without getting judgmental or angry at the person. But I don't know. It depends what your history is with this person and how he or she responds. Maybe it's just pointless. You're not going to get anywhere and just cause everyone a bunch of undue agita, or maybe you can actually move the needle a bit. So I'm not sure. Good question, though. Do you find with your clients spending the go-go, slow-go, and no-go phases of retirement? Do you find with your clients spending the go-go, no-go? Not sure entirely what you're asking, Dave Fultz. Do you find with your clients spending the go-go, slow-go? Oh, okay, yeah. So yes, there's 3 phases of retirement, commonly known as the go-go, slow-go, and no-go years or phases. You can probably figure out what they mean. Go-go is typically, depending when you retire and your general health, but let's just assume, it's your 60s into your mid-60s probably. Everyone's going to be a little different, but this is when you're still healthy, vibrant, mobile, good mind and body. You can still do travel. You can still physically move around. You don't have any, restrictions physically or mentally. That's the go-go years. That's when you often spend a lot on discretionary stuff, doing those big once-in-a-lifetime trips you wanted to do, doing, massive amounts of pickleball, doing whatever, hiking. And then the mind and your body start to slow down, typically 70-ish, into your late 70s, early to mid 80s. I don't know. Everyone's a little different again. That's the slow go years. You can still do some travel. You're probably not climbing up mountains at this point. You're probably not playing aggressive pickleball. Now maybe some slower paced pickleball. So you may spend a little less money on discretionary stuff. And then the no-go phase is kind of as it implies, the mind and or body are kind of losing steam, whether it's physically, you can't climb stairs, or you can't do any sort of real meaningful travel at this point, or maybe your mind isn't quite, whether it's dementia setting in or what it may be, you're not really doing much. You're probably, unfortunately, not necessarily bedridden per se, but don't really leave the house and do much. That's the no-go years, in which case the discretionary spending is in effect non-existent. So the spending, at least in discretionary stuff, is usually highest in the beginning. The go-go years starts to taper off in the slow go, and the no-go years, it's virtually zero. But that may be somewhat, or fully offset by increases in medical expenses. But the point is, spending in retirement is not linear. And this is why rules of thumb like the 4% rule are just super, super back of the envelope, quick sanity checks. They're not a distribution strategy. No one spends and lives exactly linear and even amounts. Life happens, financial markets happen, things change. Typically, you do spend more early on, and then it does taper off. So for what it's worth, you can kind of give yourself permission to spend a little more early with the expectation that you can or you will be spending less as your years progress, with the caveat that maybe, medical expenses really ramp up. So just another thing to further complicate all this retirement planning stuff is the unknown about stages of life, stages of spending. But yes, I do see that people want and should spend more in the go-go years. Enjoy it while you got it. Enjoy it while you can still do it. And then spending will typically taper off. Do you feel that a preferred stock exchange traded fund is a good proxy for a corporate bond fund? Is it safer than a stock fund? So for those who don't know, preferred stock is it's like part stock, part bond. It's technically stock. but it's not common stock. It's more doesn't have may not have the same voting rights as common stock. The dividend it pays is senior to common stock, meaning if and when the company cuts dividends on its preferred stock, it can't pay dividends to the common shareholders typically. It can, only if it is paying out this preferred dividend to these preferred stockholders can it then pay out common dividends. So anyway, in that sense, it's kind of like more like a bond in that it does typically have this stated annual dividend payment. Yeah, I don't know. I don't want to say it's safer. I mean, what does safe mean exactly? But it definitely is more corporate bond like than traditional stock, but it is still stock. It's not formally it's not technically a form of debt. So it's not completely a bond proxy. There's a place for it. Again, preferreds, those that do pay dividends are more stable of dividends typically than common stock. So there, from an income perspective, may be good. Preferreds are often convertible, meaning the company can convert them into I'm drawing a blank, into shares of the stock, into common shares of the stock. So that's that's a risk that may not exist with stock in the first place. You think you have a preferred, all of a sudden the company converts it, or force converts it, or maybe you can convert it if you want into shares of common stock. So it's a little more complex. God, again, not a great answer from me, but it's not a simple answer to say whether or not they're better or worse, or that it's necessarily safer than a stock fund. All else equal, I think it's probably lower risk generally, like lower volatility, little higher ongoing dividend, but I don't want to necessarily say it's safer, because there are some stocks like bellwether stocks that have always done fairly well and will likely continue to do fairly well and fairly consistent. In that sense, those stocks can be safer than some, higher risk preferred stock ETFs. So I don't want to make a generalization to say one is more or less safe than the other, but sure, point is, a preferred stock is quasi like a bond, or at least more so than a common stock. All right, 9 o'clock. Wow, still a lot of questions. More than I thought. Thank you all. I thought there'd be like 2 questions here. Me sitting here making like turkey hand signs or something, trying to kill time. We'll wrap this up not too long. I saw your mailbag video on ETF versus mutual funds. It seems like ETF is better than mutual fund for passive investment in both regular brokerage and Roth account. So could you think of any reason why someone can benefit more from mutual fund than ETF? The best I could say is check out the video. I mean, there are potential pros to a mutual fund. One is you always buy at a net asset value. There's never going to be a difference in bid-ask spread because you're not buying it on an exchange like you do with an ETF. So there's that. You can buy partial shares of a mutual fund. You can't always buy partial shares of an ETF. So like you can invest to the penny in a mutual fund, whereas you can't with an ETF. Some strategies exist only in mutual fund form. If you specifically want like an actively managed strategy, you almost certainly have to find it in mutual fund form, not ETF form. If you want, I don't know what else. I guess I'll leave it there for now. Those are kind of the big ones coming to the top of my mind. So yes, mutual funds can still make sense. It also depends where your custodian is. Like if you want a Vanguard mutual fund, you'd probably be better to buy that direct at Vanguard, because if you buy that through a brokerage account at TD or Schwab or Fidelity, you can, but they're going to charge you a trading fee, 20 to 40, depending on, 20, 30, $40 trading fee per fund, per purchase, to buy or sell mutual funds there. So it really all depends. And how I invest, in where clients' custody accounts, and for my relatively straightforward buy and hold passive trading style, ETFs work perfectly great, both in taxable accounts and IRAs and Roth IRAs. That doesn't mean mutual funds are bad. It really all depends, again, what you're looking for and why and stuff like that. But okay. Any legislative risk of non-qualified deferred comp, non-governmental 457 plans for high-income folks going away, such that rather than a 15-year payout upon separation, it will all be immediately distributed and taxed in 1 year? I thought I read that a few years ago. They were at risk. I have no idea, honestly. I haven't heard of this. Anything's possible, as you can tell from the last few months of tax legislation. All this stuff that comes out of nowhere gets kicked around and then gets, maybe it gains steam, maybe it just dies on the vine. I really have no idea about this, but good question. Can an HSA be opened after year end? Ooh, that's a good one. So it can be opened, yes. Can it be funded? That I don't know. So let's assume it's January. You open an HSA. I guess the question is, can you fund it for 2021 still? It's January 2022. I don't think so. I could be wrong. I'm almost certain you can't. Here's why I say that. The only reason why you're allowed to fund certain account types after December, such as Roth IRAs and IRAs, is because your ability to contribute is based on your income. And you don't know your full income necessarily until you actually start doing your tax return in February, March, or April. That's why the IRS gives you the leeway to make a retroactive contribution, in January, March, or April, because you need to know your income. HSAs don't have an income-based limit. The only qualifier is you have a qualifying high deductible health plan, period. So that's not dependent on your income. You don't need to start doing your tax return to know whether or not you can contribute. Either you had the plan during the year or you didn't. So I'm not 100%, but very confident in saying no. Well, you can open it after year end, but you can't contribute for 2021 after December 2021. Do you prefer safe bonds such as governmental, municipal, or high-grade corporate? Or do you believe there's a place for high-yield, aka junk bonds? I worry about a higher correlation between corporate and stocks during a decline. Man, I'm always hesitant to talk about investments because people may take this as investment advice. This is not investment advice to anyone listening, nor is it a solicitation, a recommendation to buy or sell a security. My view, and this is just my opinion, different people have very different views. I don't personally invest in high yield, aka junk bonds, because they're much more correlated to equities than higher grade, investment grade, lower risk corporate bonds or treasury bonds are. So what are you really getting with junk bonds? You're squeezing out a little bit of extra coupon income, sure, because they're higher risk, but the price swings are much more like those of equities. So I don't think junk bonds have a unique enough profile from equities that it's worth the risk. For me, in my approach, the long-term growth assets, the long-term risk assets are equities, low cost, low fee, diversified equities. The bonds, they're not really there for income because interest rates are so jokingly small. They're really just there for ballast and stability. And yes, the bond funds I use throw off 1.5%, 1.6% interest per year currently, but the price fluctuates some. So they're not really there to make people a lot of money. I don't anticipate the bond fund I use is going to get 4, 5, 6% per year on average going forward. I just don't see how that's mathematically possible with where interest rates are. But they're there for if and when they'll throw off a little bit of interest along the way, and hopefully the prices will be relatively stable. If and when the stock market tanks, economy is probably doing poor, interest rates may come down as the Fed tries to rein things in a bit, and which means the bond prices may go up, or the situation I'm concerned about, which I don't think anyone has a great solution against, is stagflation. And I had this discussion on a call with a client today. That's what concerns me. Stagflation is, so typically when there's healthy levels of inflation, it's usually good for the economy, for companies. So stock market usually goes up when there's healthy inflation. So stocks are generally a good hedge against inflation. But then there's bad inflation. Bad inflation is like stagflation, like runaway inflation without good economic growth and health behind it. So what you have is not only do stocks lose value because stocks are going down from poor economy, from whatever, yet inflations are going up, interest rates are going up, which means bond prices are going to come down. That's a bad scenario. That's when all asset classes basically drop, and that's not good. And no one has a good solution against that other than the fear-mongering snake oil salesman that got some magical product to say, hey, world's going to end. Go buy this product. I get a fat commission. You're not going to make a lot, but guess what? You're not going to lose a lot if and when the world ends. Those are the things that people try to sell you in anticipation of stocks at an all-time, stock market's all-time high, fake currencies, dollar's going to collapse, money's getting printed, blah, 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 world's going to end. Go buy my insurance product. It'll guarantee you no loss. Wink, wink. Where am I going with this? I don't know. What was the question? Man, what am I talking about? So I don't know. I don't personally use junk bonds. I keep it separate. Equities are for growth. Lower risk bonds I have for stability and a little bit of interest, but they're not growth assets. They're not going to throw off a lot of money. Junk bonds kind of sit in this weird middle place. They're a bit of both. They're not different enough from equities to really be safe. They're not what am I trying to say? That's really it. So I don't know. I don't think they have enough uniqueness of a spot in there. I don't use them. And yes, there is correlation between especially corporates, even higher grade corporates. If and when the economy struggles, even the investment grade stuff will come down a bit in price. Treasuries should go up because treasuries are typically the flight to quality asset. When times get ugly, people flood into treasuries for safety. So those prices usually go up. But corporate bonds, even the higher rated investment grade stuff, if the economy's hurting, those will come down some in price. So to your point, yes, they are correlated to some extent with equities. So they're not a hedge per se. They're just more so ballast and buffer. They shouldn't go down nearly as much as equities. Yeah. All right. I'll stop there at that one. How much is the? Oh man, I'm not getting through all these. Sorry. Maybe I am. Let's see if I can rip through this and stop talking so much. Step up in basis for inherited accounts that transfer ownership to a spouse or remain invested in the same stock or mutual fund. How is record keeping done whereby the basis is correct? The custodian that it's at should do the step up. So if you have a joint account with your spouse, one spouse passes, you inform the brokerage that, hey, my spouse passed as of, give the date of death. They should take care of the rest. They adjust the basis in their system. Now the questions may come around: is it community property if you're in a community property state, or is it joint property? Because that's going to impact how the step up happens. So that's a little bit on you and your attorney, perhaps, and maybe your CPA to figure out if you're in a community property state, is this in fact community property, in which case it gets a full step up in basis, or for whatever reason, did we decide to not keep it community property, in which case it wouldn't get a full step up in basis. So that all depends. But otherwise, the answer is tell the custodian what the date of death was. They should do the rest for you, automatically adjust basis on their records, and the rest should be good. After full retirement age, say at age 67, is it necessary or required to open a separate Roth IRA for Roth conversions, or can the converted funds simply go into existing Roth? The latter. There's never a need. You never have to open multiple Roth IRAs. You can have just one your whole life, and that'll be fine. Now, if for whatever reason you want to track or delineate between years you contributed or years you converted, just because it's easier for you to keep records of in your mind, sure, you can open multiple accounts, but you never have to, never necessary, never required. Especially if you're over 59 and a half, you don't have to worry about that 5-year rule around every year you do conversions, because you're never subject to a 10% penalty at that point. If you're 65, for example, you do a Roth conversion, you'll pay the tax when you convert it. You can turn around and take all that money out the next day with no penalty and no tax, because you will have just already paid the tax. So no, there's no need to open multiple Roths. You can if you want, but you don't have to. All right, wrapping up. Getting there, a few more. What are the big health expenses that people worry about later in life? Doesn't Medicare plus supplement cover a lot? And above that, isn't there a max out pocket per year? Is it the risk of spending up to the max, or is the bigger worry health expenses not covered? Sorry, younger person here, no Medicare understanding. Yeah, a lot of ways I can go with this one. So yes, Medicare, base Medicare, there's a lot it does not cover. For example, it doesn't at all cover hearing aids, podiatry, dental, vision, long-term care. I'm missing chiropractor. There's something else big I feel like I'm missing. Did I say vision? I think I said vision. It could be something else, but it doesn't cover those at all. Even stuff it does cover: hospital visits, or let's say just basic preventative routine, primary care visits. There's a 80% coinsurance, meaning whatever the bill is, you pay 20% of it. Medicare only pays 80%. So even with copays, out-of-pockets, premiums, you're still going to owe something with Medicare, because Medicare only pays 80% of whatever the bill is. So that's why most people often do and should get some sort of supplemental coverage, whether it's a Medigap or an Advantage plan, that sort of tax on and covers some or all of the rest. Even then, there's still things Medicare doesn't cover. Long-term care, that's a big one. Even if you have a really comprehensive Medigap, supplemental policy, I don't think any of them cover long-term care, or maybe if they do, there's only a very small portion, the first X amount of weeks or something. There might be some limited amount of long-term care through Part A. I forget, but again, it's not going to cover 3 years worth if you have like a multiple-year long-term care event. So that's kind of the big expense people worry about is the big what if long-term care. Multiple years, I'm in like a round-the-clock care facility because of physical issues, dementia, whatever, memory, Alzheimer's. That's a big expense. Some people have enough that they can self-fund it, or they're going to rely on spouse or other family members for care. So that drastically cuts down the cost, puts a significant burden on the family members giving the care, but nonetheless can help save in cost. There's long-term care insurance you can consider. Not cheap, and it's expensive to fully insure a multi-year, hundreds of thousands of dollars long-term care event. But not everyone wants and needs coverage for a full event. They may just get some. They may buy only like $200,000 or $300,000 of long-term care coverage, just a little something to take the edge off type of thing, but then fund the rest. So that's probably the big one. But just keep in mind, Medicare again, base Medicare does not cover hearing, dental, vision, podiatry. Now, emergency podiatry, like you drop an anvil on your foot and smash it, your hospital coverage will get that. But just like, ooh, my foot hurts, let me go to the podiatrist. That's not covered under base Medicare, and long-term care is not covered. Good question, whoever it was that asked that. 401k with company stock, over 400,000 of growth, low basis, high tax bracket, time for NUA. Oh man, I'm not chiming in on this. Can't say. Really difficult to say. NUA stands for net unrealized appreciation. You have to look at your, it's also a function of the year you do this distribution, what your taxes look like then, how much additional tax you're piling on yourself with doing it. If you got a low basis, it may not be that bad. $400,000 of unrealized gains, that's still a large amount of gain to pay tax on, which is going to be 15 or 20% plus the 3.8% net investment income tax plus state tax anyway. So all in, the total amount of tax savings on this may not be substantial, frankly, when you piece it all together, compared to what taxes you might ultimately pay on this if you just roll into your IRA. So I'm not saying do or don't do it. I'm just saying NUA is never a black and white decision, or never an obvious answer in the handful of times I come across it, just because the savings end up not being as much as it may look on the surface. With $400,000 of growth, that may be a sizable amount of savings. Yeah, but it really depends. It depends how much other tax-deferred assets you already have. It depends how much income and what tax bracket you're in now when you do it. So there's more to it than meets the eye, but worth considering at least. But I definitely can't say you should or shouldn't. Oh, what is this? Hold on. You have until tax filing deadline to fund your HSA. Really? Okay, I'm not saying you're wrong. I'm just saying I'm surprised by that. It goes against the reason for why I thought they typically give the tax return deadline to fund like an IRA or Roth IRA, because you need to know your income in order to do it. But good to know, whoever said this. I'll assume that's accurate. So whoever asked the question initially, here you go. I'm still surprised by that. It's nice that they do that, but that's interesting. Okay. All right. Final question of the night. No more questions, please. What do you think about using variable universal life for a tax advantage investment? Go back and check the video I did with Chris Kirkpatrick on my YouTube channel, Retirement Planning Demystified. That has, he's an insurance expert. I'm not. I know enough to have an educated conversation about it. He's the expert. He and I talked for an hour about cash value life insurance as a first and foremost, it's life insurance. It always is. It always will be. The cash account, the cash value features, the potential growth features, the tax deferral features are secondary ancillary benefits of it, first and foremost being life insurance. So anyway, so with that said, sure, the cash value features can play out well, can have cash flow benefits to them. Basically you build up cash value, you take a loan against it. It's not really income per se, because you're not getting income. You're simply taking a loan from the insurance company and they're collateralizing it with your life insurance policy. Not to say it's necessarily bad, but I think these things are often misrepresented to folks when they're pitched. So I hesitate to call it an investment, because again, it's life insurance first and foremost. Yes, you can accumulate cash value. Yes, you can take that value out, or you can take loans against it. Sure, it could work. It's not a slam dunk that it's always going to be good. You need time for it to bake. There's going to be there's cost of insurance that are involved, because again, first and foremost, it's insurance. So you can't compare this apples to apples versus traditional investments, because there's this insurance component that costs money. All else equal, that's going to drag on the investment returns you'd otherwise get inside this policy. So I don't know, but check that video, Chris Kirkpatrick. It was 6-7 weeks ago, probably. You'll see a lot more thoughts about cash value life insurance. We didn't specifically talk much about variable. We talked about indexed and whole life, but still, I think a lot of the commentary and insight should apply just the same. All right, that's it. Thank you all. Happy Thanksgiving. Happy healthy. I will see you again next week. I don't even remember what the topic was for next week, but I'll see you again. We are wrapping up soon. Taking the last 2 weeks of the year off from doing these lives as we did last year. So probably only another, 3 or 4 of these left. One more special guest, Stephen Jarvis, will be coming on in December to talk about how to bridge the gap between your tax return preparer and your financial advisor to make sure you're getting, ideally getting cohesive, integrated kind of tax planning that bridges both of those universes. So that'll be a good one. And there's one more mailbag coming up, and something else, some other topic, inherited IRAs or inherited RMDs, something, I don't remember, whatever. Point is, I'll see you again. So thank you all. Have a happy, healthy, and I will see you in a week. Take care.